October 1929 has become one of the most familiar scenes in economic history. Crowds gather to behind the market. Fortunes disappear before brokers can complete a telephone call. Men who believed they were wealthy on Monday discover that their shares cannot cover their debts by Tuesday. This is the moment most people associate with the beginning of the Great Depression. And it was a devastating moment. The collapse destroyed confidence, damaged banks, reduced spending, and exposed years of speculation financed with borrowed money. Yet a stock market crash in New York does not automatically explain why factories closed in Canada, why German banks ran out of foreign currency, why British trade policy changed after generations of relative openness, or why farmers across several continents watched the prices of their crops collapse together. The crash wounded the American economy. It did not by itself create every part of the global disaster that followed. The deeper story involves a fragile chain of international debts, a farm crisis that had already lasted most of the 1920s, a tariff designed as political protection, retaliation from trading partners, shrinking credit, banking panic, and governments that increasingly believed they could survive only by shutting others out. The world did not simply fall into depression. One government after another began closing the doors through which money, goods, and confidence had once moved. To understand why those doors mattered, we need to return to the years after the First World War. The war ended in 1918, but its financial obligations did not. Germany owed reparations to the victorious European powers. Britain, France, and other Allied governments owed wartime debts to the United States. Yet much of Europe had been physically damaged, politically destabilized, and financially exhausted. The countries expected to make large payments were often the same countries struggling to rebuild their factories, currencies, and tax systems. By the middle of the 1920s, a circular arrangement had emerged. American banks and investors lent money to Germany. Germany used part of that money to make reparations payments to Britain and France. Britain and France then used part of their receipts to service debts owed to the United States. On paper, money appeared to be moving successfully through the system. In reality, much of the arrangement depended on a continuing supply of new American credit. Germany was not simply paying the Allies from a permanent stream of export earnings. It was borrowing abroad while trying to rebuild the capacity to earn the foreign currency its obligations required. The Dawes Plan of 1924 reorganized German payments and helped attract foreign loans. It reduced immediate pressure and contributed to several years of relative stability. American banks continued lending enough to help Germany meet reparations, while the recipient governments used those payments to service war debts. The Young Plan later attempted to create a longer-term settlement, but it arrived just as the global economy was beginning to contract, as often described as international cooperation. In one sense, it was. Banks crossed borders. Governments negotiated payment schedules. American capital helped European economies stabilize. But it was cooperation without a dependable emergency mechanism. There was no institution capable of replacing private credit if American lenders withdrew. There was no shared deposit insurance system, no coordinated fiscal rescue, and no central authority able to force creditor countries, debtor countries, and gold-holding countries to adjust together. The financial machine worked only while every major part continued moving. Germany needed loans and export revenue. Britain and France needed German payments. American investors needed confidence that European borrowers would repay. International banks needed currencies to remain convertible, and governments to respect the rules of the gold standard. Remove one critical flow, and the machine would not merely slow down. Its obligations would begin colliding with one another. And even before Wall Street collapsed, another part of the American economy was already in distress. For many American farmers, the 1920s never truly roared. During the First World War, European agricultural production had been disrupted. Demand for American wheat, corn, cotton, meat, and other products increased. High prices encouraged farmers to plant more land. purchase equipment, and borrow money to expand. The logic appeared sound. Europe needed. Food prices were strong, and modern machinery promised greater output. Then, the war ended. European farms gradually returned to production. Agricultural output also expanded in countries outside Europe. Supply increased while wartime demand weakened. American farmers discovered that the debts they had taken on during high price years remained fixed even as the prices of their crops declined. A loan does not become smaller because wheat becomes cheaper. A mortgage does not adjust itself because cotton prices fall. The farmer still owes dollars, while each bushel or bale produces fewer of them. By the second half of the 1920s, overproduction and falling prices had made agriculture one of the weakest sectors in the American economy. Herbert Hoover entered the 1928 presidential campaign promising relief, including higher tariffs on imported agricultural products. The proposal had an intuitive political appeal. If foreign goods faced higher taxes at the border, American farmers might face less competition in their own market. It's presented as a shield: protect domestic producers, preserve employment, reduce dependence on foreign goods, and keep American purchasing power inside the United States. For a farmer facing foreclosure or a factory worker afraid of losing a job, that argument could sound more convincing than an abstract warning about international trade. The benefit appeared local and immediate. The danger appeared distant and theoretical. But a shield held by one country can look like a weapon to everyone standing outside it. The tariff legislation that followed became associated with two Republican lawmakers, Representative Willis Hawley of Oregon and Senator Smoot of Utah. What began as an effort focused heavily on agricultural relief expanded as it moved through Congress. The reason was political arithmetic. If wheat received protection, a lawmaker from an industrial district wanted protection for textiles. If textiles received protection, another representative demanded higher duties on chemicals, glass, sugar, wool, metal goods, or manufactured products, important to voters back home. Each industry could explain why it faced unfair competition. Each member of Congress had a reason to secure one more favorable rate. The result was not a single strategic tariff aimed at one vulnerable sector. It became a vast collection of bargains. Thousands of tariff classifications were reconsidered, with lawmakers exchanging support for one another's preferred duties. This process is sometimes described as log rolling. One politician supports another politician's demand in exchange for support for his own. Each individual bargain may look small. Combined, they can produce a policy far broader than almost anyone originally proposed. By the time the bill approached final passage in 1930, the American economy was already contracting. That made protection more politically attractive, not less. Economic fear strengthened the argument that domestic markets had to be reserved for domestic producers. Warnings were not absent. Exporters feared that foreign customers would retaliate. President Hoover himself had reservations about the bill's wide scope and the possibility of retaliation. More than 1,000 economists signed a petition urging him to reject it. Hoover signed the Tariff Act into law on June 17, 1930. It created the Depression from nothing. The American downturn had begun before its enactment, and economic historians continue to debate how much of the subsequent collapse can be attributed directly to Smoot-Hawley. Monetary contraction, bank failures, falling spending, private debt, and the international gold standard all played enormous roles. It is also misleading to imagine that the law suddenly placed the highest tax in history on everything entering the United States. Tariff measurement is complicated. Many duties were fixed amounts rather than percentages, so falling import prices automatically made those duties appear larger relative to the value of the goods. Some products remained duty-free, and the United States had already maintained high tariff barriers under earlier legislation. Still, Smoot-Hawley raised protection across a wide range of agricultural and manufactured goods. More importantly, it arrived at the worst possible moment and carried a powerful political message. The United States was not merely another economy. It was the world's leading creditor. European governments owed it money. Foreign borrowers depended on American banks. Producers around the world needed access to American consumers in order to earn dollars. The largest creditor country was effectively telling debtor countries that they must continue making payments while finding it more difficult to sell goods into the creditor's market. That was the contradiction at the center of the system. A country can acquire foreign currency in several basic ways. It can export goods and services. It can sell assets. It can receive investment, or it can borrow. If access to export markets shrinks at the same time that lenders become cautious, the options disappear quickly. America wanted fewer imports, but it still expected debt payments, profitable overseas investments, and strong foreign demand for American exports. All of those goals could not be maintained simultaneously in a collapsing world economy. The first major retaliation came from the country most closely connected to the American market. Canada was the largest destination for American merchandise exports. As Smoot-Hawley approached passage, the Canadian government faced growing pressure to answer American protection with protection of its own. In May 1930, Canada imposed countervailing duties on 16 categories of American products, covering a substantial portion of U.S. exports to the Canadian market. Further increases followed after a change of government. Canadian retaliation was not a minor diplomatic gesture. It demonstrated the political mechanism that would repeat elsewhere. Once one government raised barriers, foreign leaders had to explain why they were allowing domestic industries to suffer without responding. Doing nothing could be portrayed as weakness. Retaliation could be portrayed as national defense. IFF, introduced during the 1930s, was a direct response to Smoot-Hawley. Britain's later abandonment of its traditional trade policy, for example, reflected broader depression pressures and was not simply an act of revenge against the United States. Economic historians disagree about the scale of direct retaliation caused by the American law. Yet the distinction mattered less to a business losing customers. Whether a barrier was technically retaliation, emergency policy exchange control, or imperial preference, the result was similar. Access to foreign markets became more difficult. Countries raised tariffs, introduced quotas, restricted the movement of currency, subsidized domestic producers, and created preferential trading arrangements. Britain and its dominions moved toward imperial preferences. Governments attempted to reserve scarce foreign exchange for essential purchases. Some currencies were devalued in an effort to make exports cheaper, while countries remaining on gold faced pressure to cut prices and wages. The trading system was not destroyed by one identical policy adopted everywhere. It fragmented through many defensive measures, each justified as a response to national emergency. Imagine a street of shops during a sudden collapse in income. Every shop owner needs customers, yet each owner also fears that money spent in another shop is money lost at home. One by one, they lock their doors to outsiders while placing signs outside demanding that others continue buying from them. The strategy may feel protective from inside each building. Across the entire street, it guarantees that fewer transactions take place. The scale of the contraction was extraordinary. U.S. exports to Europe fell from roughly $2.34 billion in 1929 to about $784 million in 1932. Imports from Europe fell from approximately $1.33 billion to $390 million. Measured in nominal value, world trade declined by about two-thirds between 1929 and 1934. Although falling prices accounted for an important part of that decline. Did not produce this collapse. People who have lost jobs buy fewer imported goods. Companies facing bankruptcy order less foreign machinery. Deflation reduces the dollar value of products. Banks refuse to finance shipments. Currency shortages make payment difficult. Trade was falling because the depression was worsening even as protectionism made the fall more uneven and the recovery more difficult. This is where the trade war and the broader financial crisis began reinforcing one another. Consider the American farmer the tariff had been designed to help. A farmer might have benefited if imported produce became more expensive in the local market. But many American farmers did not depend only on local buyers. They produced wheat, cotton, tobacco, meat, and other commodities for export. When foreign governments raised barriers, foreign buyers found alternatives, or foreign incomes collapsed, American agricultural exports suffered. Unsold crops accumulated. Prices fell further. Revenue disappeared, while mortgage payments, equipment debts, and taxes remained. A family operating a farm did not experience this as a debate about tariff theory. It experienced it as a set of impossible choices. Should the family use its remaining cash to pay interest to the bank? Should it buy seed for another planting season? Should it repair a machine? Should it keep food for itself rather than sell at a price that might not cover transport? No single representative family can capture every agricultural region, but the underlying pressure was common production continued while the value of production collapsed. The same pressure moved into rural banks. A local bank's assets often consisted largely of loans to nearby farmers and businesses. When borrowers could not pay, the bank did not simply lose future profit. It lost the cash flow needed to satisfy depositors. If depositors became frightened and demanded their money at once, the bank might be forced to sell assets at depressed prices or close its doors. Farmers then lost access to new credit, which forced more liquidations, which reduced land and commodity prices, which weakened other banks. The tariff was not the sole cause of this spiral, but the loss of export markets made the arithmetic worse for precisely the communities protection had promised to rescue. The international debt system faced a similar contradiction on a larger scale. Germany needed foreign currency to service external debts and reparations. It could obtain that currency by exporting borrowing or attracting investment. During the second half of the 1920s, American loans had covered much of the gap. After the Wall Street crash, American capital became more cautious. Banks sought liquidity. Investors avoided foreign risk. Loans that had once appeared renewable were called back or allowed to expire. At the same time, collapsing demand and rising trade barriers reduced Germany's ability to earn foreign exchange through exports. This was not merely a problem for Germany. German reparations payments were connected to the ability of Britain and France to service wartime debts owed to the United States. The failure of one payment stream weakened confidence in the next. A tariff appears to block a physical product, a sack of grain, a machine, a chemical, a roll of cloth. In an indebted international system, however, trade is also a payment mechanism. Exports are how countries earn the currencies required to settle obligations abroad. Blocking goods could therefore obstruct the flow of money holding the post-war settlement together. The central paradox was becoming impossible to ignore. Creditor countries wanted repayment, but resisted the imports that would allow debtors to earn the money. Debtor countries wanted access to markets, but protected their own industries. Governments wanted stable currencies, but feared the domestic unemployment caused by defending those currencies. The system demanded cooperation at exactly the moment domestic politics rewarded confrontation. By 1931, the crisis had moved far beyond stock prices and customs schedules. In May, Austria's largest bank, Kreditanstalt, revealed losses severe enough to undermine confidence in the institution. The bank's problems had deep roots, including weak assets and burdens created by earlier mergers. Smoot Hawley did not cause its failure, yet the environment surrounding that failure had become exceptionally dangerous. Trade was shrinking. Foreign lending was retreating. Governments and banks faced large short-term obligations. Investors feared that states would impose exchange controls, suspend payments, or abandon their currencies. Financial fear spread from Austria toward Germany and other parts of Europe. Depositors and foreign lenders attempted to withdraw funds. Governments introduced controls to prevent capital from leaving. International finance, which had helped create the apparent stability of the 1920s, now transmitted panic across borders. The gold standard intensified the pressure. Under the system, currencies were linked to gold at fixed values. A government experiencing a gold outflow was expected to defend the currency, often by raising interest rates, restricting credit, and reducing domestic prices. Those measures could reassure investors that the currency would remain convertible. They could also deepen unemployment and bankruptcy inside the country. In September 1931, Britain left the gold standard. The decision protected Britain from some of the deflationary pressure required to maintain convertibility, but it also created new fears elsewhere. Investors questioned which country might leave next. Governments still committed to gold often responded with tighter policies, even as their economies weakened. The crisis was moving through four connected channels: trade, debt, banks, and currencies. Decline in trade reduced export earnings. Lower earnings made debts harder to service. Fear of default weakened banks. Banking panic reduced credit. Reduced credit lowered production and trade again. Deflation increased the real burden of every remaining debt. Each country saw a reason to protect itself from the next stage of the chain. Together, those acts of protection made the chain more destructive. Economists later popularized the phrase "beggar thy neighbor" to describe policies intended to improve one country's position by transferring economic pain elsewhere. The government could devalue its currency so its exports became cheaper relative to foreign goods. It could impose tariffs to redirect spending toward domestic producers. It could restrict imports to preserve gold or foreign exchange. It could require companies to buy nationally produced materials. It could build a closed trading bloc around colonies or political allies. Any one of these measures might provide temporary relief to a particular industry. The problem emerged when many countries pursued them simultaneously. Every government wanted to export more. Few wanted to import more. Every government wanted to conserve gold and foreign currency. Few wanted to provide the spending that would allow another country to earn them. The attempt to export unemployment did not eliminate unemployment. It distributed distrust. Smoot-Hawley therefore matters not because it offers a complete explanation of the Great Depression, but because it reveals how domestic political incentives can damage an already fragile international system. In purely numerical terms, foreign trade was not large enough to explain the entire collapse of American output. One economic history assessment notes that the fall in real exports may have played an important role during the early contraction, but not a decisive one, and that much of the decline would have occurred even without tariff retaliation, because foreign incomes were collapsing. The money supply contracted. Thousands of banks failed. Household spending fell. Investment disappeared. The Federal Reserve did not provide sufficient support to stop banking panics and deflation. The gold standard transmitted contraction internationally. These forces were at least as important as trade policy, and in several interpretations, much more important. Squirted the set insect, disasters are not built from one cause. They become catastrophic when several weaknesses begin amplifying one another. Protectionism weakened exports and damaged political cooperation. Banking failures destroyed credit. Deflation increased debt burdens. The gold standard limited policy choices. International debts linked the survival of one government to payments from another. Fear made voters and lawmakers less willing to accept foreign goods, foreign loans, or foreign claims. The result was not simply a smaller global economy. It was a more divided political world. As unemployment rose and established governments appeared unable to restore prosperity, political movements offering decisive national solutions gained influence. International cooperation could be portrayed as surrender. Trade dependence could be portrayed as vulnerability. Economic self-sufficiency could be presented as strength. In some regimes, the pursuit of autarky, the attempt to reduce dependence on foreign trade, became connected to military planning and territorial expansion. If a country believed it could not safely obtain food, fuel, minerals, or markets through peaceful exchange, controlling those resources directly could appear strategically attractive. Protectionism did not cause the Second World War. It did not create every extremist movement, erase the consequences of the First World War, or determine the political future of every country. The road to war included dictatorship, militarism, racial ideology, territorial disputes, unresolved grievances, and failures of collective security. But economic nationalism helped weaken the habits of cooperation. It divided countries into competing blocs and made international problems appear increasingly incompatible with national survival. That is the broader significance of the trade war. The famous photographs of October 1929 show us the visible shock: a market falling, investors panicking, numbers disappearing from a board. The decisions that followed are harder to photograph. A tariff schedule changes in a committee room. A foreign government introduces a quota. A bank refuses to renew a loan. A central bank raises interest rates to protect gold. A farmer receives less for a harvest. A factory loses an overseas customer. A country imposes currency controls because it fears the money will leave. Individually, each decision may appear defensive. Together, they can transform a downturn into a system-wide collapse. Smoot-Hawley was not the single law that created the Great Depression. The global economy was already unstable. The American downturn had already begun, and powerful monetary and banking failures would have caused enormous suffering even without it. But the tariff became a symbol of something larger, the moment when fear began replacing coordination, when the world's leading creditor made it harder for debtors to sell, and when governments increasingly answered economic contraction by restricting the exchange on which repayment and recovery depended. The crash injured the system. The collapse of credit, the banking panics, the constraints of gold, and the retreat from trade prevented the injuries from healing. The most dangerous point in a crisis may not be the instant markets fall. It may come later, when frightened countries decide that survival requires turning against one another, and discover that everyone else has reached the same conclusion. Was Smoot-Hawley a decisive turning point? Or has its role been exaggerated compared with banking failures, monetary contraction, and the gold standard? Share which factor you believe mattered most, and subscribe for more documentaries exploring the hidden economic forces behind history's greatest wars, political upheavals, financial crises, and empires.